Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and we've had some spectacular developments in the past 24 hours, and they weren't just with Jerome Powell's address to the Senate inquiry or Senate committee. His comments, of course, were exactly confirming my forecasts all along. And that is, yes, even here, the Fed funds rate is going a lot higher than most people anticipate. And it's going to be in the order of 5.75% at least, probably as high as 6.25, 6.5. And my risk scenario through all of this has always been 7.5% as the terminal rate for the Fed funds. So, up at those numbers, where would you think the equity market was, and what do you think the US economy would be doing? I mean, that's what really matters, the real world impact of these interest rate adjustments. It's not just about, oh, do we react on the day bullish or bearish in equity markets? No, it's the profound, lasting, enduring impact of all these rate hikes upon the US consumer, US businesses, small, medium, and large. All of their borrowing costs, all of the consumer excitement about their products, all tarnished by these Fed funds rate hikes, and there's plenty more to come. In fact, the chairman alluded to the fact that there could even be a 50-point rate hike, a stepping back up. Now, I think I probably stood alone the day the Fed first moved to 25-point rate hikes. Exactly after that announcement, I said the Fed has probably made a mistake, and it has stopped doing 50-point hikes far too early. So again, the Fed Chairman Powell has agreed with my view on things. So that's all very nice. But it's not so nice for the stock market, and it's not so nice for currencies such as the euro and the Australian dollar, which had got all excited about the idea that the Fed would pivot. And that, of course, well, you know, you may have heard of voodoo economics. No, now there's a thing called fairy tale economics, because anyone who's used the word pivot to describe what could happen this year with the Fed funds rate is a fairy tale economist. So it was never going to happen. It was completely a non-starter, but it generated a lot of volatility for those New York firms who earn a living from brokerage volume. And sometimes I wonder if some of these nonsense ideas really are planted for that purpose. So we said all along that, yes, there's this big rally at the start of the year, but be careful, because reality of further Fed hikes, aggressively so. And not only that, not only is the Fed taking rates a lot higher, but when they stop hiking, which is a long way off, by the way, but when they stop hiking, they're not going to be cutting. They're not going to be cutting rates. So, you know, the economy could be negative GDP 1 or 2 quarters, but if inflation is still resilient, the Fed is not going to cut rates. So we're looking at, and by the way, I've made this point before, US interest rates right now are low and stimulatory. Okay, that's where US interest rates are now. By historic standards, they're very low and need to move higher. So this is why the rate hikes seen so far have had little material impact on inflation. The only rolling over inflation that we've seen is as all of that Ukraine conflict, goods price increases came out of the market. Oil prices dropped back, food prices dropped back, natural gas prices dropped back for a while, but I think despite some recent volatility in the last couple of days, they're probably headed back up now. And we know that oil prices have been headed back up, but oil and gold had big falls and continued to be weak on the day. But of course they did, because you have the Fed saying it's going to be hiking rates perhaps by 50 points, and it's going to be hiking aggressively regardless. You know, it really doesn't matter whether they do 50 or 25 at the next meeting. That's not material. What matters is that it's either going to be 50 and 3 or 5 25s, or it's going to be 5 or 7 25s. Fed funds rate is going a lot higher because inflation is reaccelerating. So it's inflation, services inflation, which the chairman directly addressed several times in his testimony yesterday, is very, very strong. In fact, it's accelerating again. That is in the face of all the Fed fund rate hikes we've already seen, which is why I said the Fed is losing the war. That's why they're thinking of bringing out battleship again in terms of a 50-point rate hike. Inflation is going back up. Now, for a few days, it's nice. It'll help the inflationary pressure. The oil prices fall. That'll flow through into gasoline prices, but gasoline prices are already trending higher in the US. So it may not be such a great impact in terms of diluting inflation again, because it's really services developed now. The chairman is wrong on one thing, and I'm always quick to point out where the Fed and the RBA are wrong, and usually I'm correct. So touch wood, because I can't get it right all the time. But he suggested that the US does not yet have a wages prices spiral. I would suggest to you that perhaps it does. So if that is the case, it's just further fuel on the fire of ever higher Fed funds rate hikes. So, yeah, but do remember, by historical standards, US rates are still at stimulatory levels. That's why they've got to go so much higher. That's why all along I said the target, I've been saying for over a year, the terminal rate will be 5.75 to 6.5% when other people said it'd be 3%. It's going to be 5.75 to 6.5%, risk to 7.5. And more other major economists in the United States are joining my view at 6.3 and 6.5 calls. So there's plenty of upside for interest rates. There is no pivot. What does that mean for stocks? Yeah, so, and then on top of that, we've also had in the last 24 hours, the new foreign minister for China, who, by the way, was the former ambassador to the United States based in Washington, of course. So he knows the groundwork in Washington pretty well. So he'd be very aware of the impact of his remarks. Just gave a speech saying, basically, this is the gist. China's patience has run out. If the United States keeps being assertive towards them, too assertive as it has recently over Taiwan, there is risk of conflict. He basically also said that if the US continues to pursue what is seen by China as an aggressive path of containment of the Chinese expansion, that also could lead to conflict. So these were very strong, and they followed on from the president in the previous sort of 12 to 24 hours, who made some pointed remarks as well. But the foreign minister has really come out blazing, and that is a shift. That is definitely a shift. China's saying, look, this is the Chinese point of view, I believe, but I'm humble, someone may know better than I. They're basically going, America, we've been patient, you've been saying all sorts of things about us, you've been doing all sorts of things, accusing us of all sorts of things, and you've been, Nancy Pelosi went to Taiwan and all these other things. We've had enough, don't do it anymore. If you do, there will be retaliation. So that's hugely different to just purely diplomatic exchanges of the past. So I trust, hope, pray, and don't think, but only marginally, there's going to be a conflict between China and the United States. It would be a disaster. However, most assuredly, the risks of that happening just stepped up a major notch. And this is when, in Ukraine, Bakhmut is fully surrounded by Russians and is likely to fall, which will create an entirely different military front scenario, which is very favorable towards Russia at the moment. So that situation could have an uptick. China's had enough with the United States and said no one will tell it how it's going to conduct its own relations with other countries, and that would be a reference with Russia. So China's really saying, no, you know what, we're a superpower too, so no, we're not going to take it anymore. Now, whether you believe, agree, whatever, there's no doubt the risks, just geopolitical risks, are rising again. And the Fed's going to be hiking interest rates. All of this adds up to stocks are hugely expensive where they are now. The other thing I'd leave you with in terms of market impact is what happens to the Australian equity market and the Australian dollar if there is a military clash of any kind between US and Chinese forces, or even an increased aggressive kind of posturing between the two sides than currently exists, a more intently focused posturing. It means equity markets would fall sharply and the Australian dollar would take a very big dive as global investors reevaluated what kind of idea it was to be invested in Australia in the broad region of conflict, an ally of the US whose major export revenues come from China. That reevaluation could happen very quickly. So I'd suggest you, in terms of your Australian portfolio, be very careful over coming days, weeks and months. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.